We are kicking off this hour with part 2 of my exclusive interview with J.P. Morgan Chairman and CEO Jamie Dimon. He weighed in on rising competition and the threat of Amazon, especially after the recent Wall Street Journal article calling him and Amazon CEO Jeff Bezos frenemies.
We're not frenemies, we're friends. I have enormous respect and trust in Jeff,
and they're
going to do what they want to do. You know, so this is, I always tell people, well, this is Jeff competing, and obviously he's one of the great competitors of all time. But it could be anyone out there: fintech companies, tech companies, foreign companies. When you're in my shoes, you have to assume they're coming. You have to assume they're good. You've got to get your people to work inside so we can win in the marketplace. And I'm not going to win by being scared. I'm going to win by working hard and doing the thing that we need to do. So they're already, you know, some of these people are already in. You know, they have Amazon Pay, and people already have a lot of different things they're working on. Our job is to do the best we can. And we'll want to collaborate or compete with anybody out there.
But has the competitive landscape gotten tougher? You've got China here, you've got technology here trying to get market share, you've got the smaller banks trying to get some market share, and they've got a much better regulatory environment that they face than the larger banks.
Which we supported, by the way. We're one of the biggest banks to the smaller banks, community banks. We thought they should have regulatory relief. We were 100% supportive of that. I hope, you know, that it works. I hope that they do good things. They do things that we can't. And so the competitive environment has gotten tougher, but I think it's good. Okay, this is, remember, you want competition. You want innovation. You want growth. And it's kind of, it's almost like I would say it's normalized. Everyone's competing again. That's good. You know, for a while, some people wouldn't touch financial services. You know, people had to make up for mistakes in the past. Some competitors were taken off the playing field. That you shouldn't give too much comfort from that. The normal state of affairs, you have tough competition.
Speaking of normalized, the Federal Reserve is trying to normalize interest rates now, raising rates from these rock bottom levels that we were at. Is the Fed doing the right thing in your view? How many Fed hikes do you think we should see in the year ahead, and how many might we see?
Yeah, I remind people years ago, you know, the Fed didn't forecast and all that type of thing. Paul Volcker raised rates effectively 200 basis points on a Sunday night. No one completely knows the future, so the Fed obviously has to be data dependent. And I think that data dependency is both interest rates and maybe how they manage the balance sheet a little bit. They are very bright people. I have enormous respect for Chairman Powell. And they'll look at the situation and adjust it accordingly. But my own view is if we had good growth, raising rates, normalizing, so normalize would be kind of 3% the short end and maybe 4% the 10-year, is a good thing. Now, obviously, if we're not growing rapidly and they're raising rates, that's not as bad, or if it's because of inflation. So that's what the judgment calls they have to make. When should they do it? But the American public is far better off with having good growth and rates going up a little bit than not good growth and rates not going up.
Yeah, but the problem is the Fed's doing it two-pronged, right? They are raising rates on the one hand, but then they're unwinding this enormous balance sheet. And remember when the balance sheet was $750 billion, they took it all the way up to $4.5 trillion. It was good for banks and the economy when they were adding all of this stimulus. It's got to be bad that they're taking it away, no?
I think the better way to look at it is we don't know exactly what it did. So we know, you know, you can hypothesize that it raised prices, you know, financial prices, et cetera. It probably did. And our best economists think it maybe raised the 10-year rate by 1%, you know, stock price a little bit. But you're absolutely correct. We don't know exactly what it did, so it's hard to know exactly what the reverse is. But remember, the Fed doesn't have to do everything. They can stop. They can change their mind. They have a lot of tools at their disposal. So I'm not worried about it. They're kind of navigating this change. They're, you know, going to what I call a more normal environment. That normal environment, in my view, will one day mean they're not going to be forecasting rates. They will simply be telling the world that we'll always be data dependent, looking at a lot of different things and react to that.
So what does this environment feel like then to you? Because you've seen so many cycles. And I remember back in the 90s when the Fed raised rates twice by 50 basis points and then 75 basis points in one shot. And then that year, I believe it was 94 or 95, the market soared.
Yeah.
So how would you compare this period that we're in right now?
Yeah, you know, people, sometimes they just worry too much. You know, like all these years we've had enormous growth in the American economy. And, you know, we've lived through very tough times. I can go back to '74 recession, the '82 recession, and then things that looked dramatic but weren't nearly as bad, like the '87 market crash or even the internet bubble, where it didn't destroy the American economy. It kind of caused a huge pause or something like that. And I look at this a little bit more as like we're just slowing down a little bit. A lot of concerns out there, a lot of geopolitical issues. You know, sentiment went from kind of global synchronized growth to maybe it'll be bad. Maybe we'll go into recession. So, you know, it doesn't look to me like that's taking place. I think it is just a slowdown. And that, you know, you had good jobs data recently.
Yeah.
So as data comes out around the world in January and February, and it's not so bad, people may take a breath. take a deep breath, and markets will open up. And that does not, there will be a recession one day. So when people say, is it going to be a recession? Yeah. I don't know when it's going to be, but there will be one, and something will trigger it, and it'll be a little bit different than the last one.
So you don't think markets, though, are indicating a recession is on the horizon over the near term, then?
No, I think markets are overreacting to short-term sentiment around a whole bunch of complex issues.
What about the shrinkage in money supply?
But actually, I should have said some of it is a rational response. So, stock prices are at 18 PE, and now they're at 16 because you think there's going to be slower growth, higher chance of recession, higher chance of a trade war. That is a rational adjustment. You shouldn't say that that's irrational. You and I would say that's probably pretty rational. You pay less under that environment because you think the future is going to be very different than you thought it was before.
Actually, you know better than I do, but when I think about things, the Federal Reserve makes a pivot. They say they're in no rush. Earnings have been pretty strong. We just had great jobs numbers on Friday, 312,000 jobs created. Valuations are better after the last 3 months.
Yeah.
Seems like we could be poised for a rip-roaring rally.
Yeah, that's why I think people react. I don't know about rip-roaring rally, but I think you're going to have decent growth in 2019 in America. And therefore, Senate may reverse course a little bit down the road. I hate guessing about the future. I run my business like serving you as a client.
Right.
And then we navigate the ups and downs of markets.
But just to be clear, when you look at what happened in the inversion, or when you look at the no high-yield debt issuance, that's real time, and that's telling us something right now. It's not speculating.
Yeah, I think that's true. But again, I look at the inversion a little bit. Because of QE, I wouldn't give it as quite high importance as I would have before. We don't know the exact effect of QE, and I still suspect that somehow that 10-year bond today should be at 4%. Now, I've been wrong about that, but when you've had 2% inflation, a normal 10-year bond rate is 4%. And we don't have that, and that may be because of not just U.S. QE, by the way. So if you're the Federal Reserve, you've had QE around the world. For a long time, the ECB was buying 100% of sovereign debt issuance in Europe. And for a couple of years, that was true here. We've never seen something like that before. Maybe during World War II we had some of that, but so we don't know exactly what the reverse will be. But I have a little faith in that our folks will navigate it properly.
Which is my point. The money supply is a very different situation than it was in the good old days.
Yeah.
So does that worry you? You sell money.
So yes, again, I've written about this concern. Regulatory policy and monetary policy are interlinked in a completely different way than they were before. And I don't fully understand the full effect of that. So I do think reversing QE in a different regulatory environment may have a different effect than we think. But on the other hand, the Fed's not going to sit there and ignore it. They know that too, and they'll respond accordingly.